Despite a promising start to the year, the Swix index just managed to post a positive return of 0.9% for the first 3 months of the year. Other indices, like the listed property index, delivered a stellar return of 9.1%. So what can passive investors for the rest of the year expect? Nerina Visser from Nedbank Capital joins us in studio to discuss the scenario. So do away with fund managers. Is that the overriding message here?
Definitely not.
Well, we won't have a show. That'll be it for Investment 360, won't it?
True. No, definitely not do away with fund managers. Also, definitely don't do away with active fund managers. I think it's quite important that one understands the role that passive can play in a portfolio. I'm very glad that we have an opportunity to look at all these different indices and different passive opportunities, because I think a lot of people still think of passive and of ETFs as only giving you the broad overall market. You started off talking about the Swix 40, for example. That's one particular broad market index. We have several others in our market as well, and all of them give you different performance over different times. But then you also have the sector-specific ETFs and indices, so the Resi, the FINI and the Indy, for example. Property, the top performer for the last quarter. But there are also indices that track international markets, or they track, say, the dividend plus, the high dividend paying shares, or preference shares. So when we talk passive, it really is giving you a very clear and targeted exposure to a particular part of the market or aspect of the market, and that's the power of passives in terms of your portfolio construction.
How do you feel, Warren, just as a matter of interest, of passive versus active, this whole argument?
I'm very much on both sides. So I kind of subscribe to that core satellite approach where you use passive as the core and then you use active managers. So
you don't want to upset anybody at the other.
Sitting on the fence, I guess you could call it. But I think what I wanted to ask Nerina is obviously such a broad, diverse performance. The Swix index, which is the broad index there, we now have 4 products that track that index.
Yeah.
What's going on? We have guys coming on. We've had Brett Lundman on the show. We've had you. We've had your colleagues from Absa Capital. Why are they liking to replicate the same index in products? Is it they just need to have that product in their suite of products to offer to their clients, or why do we have 4 products of the same index?
I think the latter is absolutely right. It is about offering the full suite in your product range. I can't talk on behalf of my colleagues and my peers' business strategies or models. Personally, I think that the market in South Africa is not quite there yet to sustain so many different versions or ETFs following the same underlying index. But I do understand where they're coming from in terms of wanting to offer the same, sort of the full suite of products in their boutique, if I can call it that. For us, the focus is a lot more rather on what is the indices and what do they provide you, and why would you include a certain index and therefore a passive exposure to that index in a client's portfolio. So you would be looking at what am I actually getting from that? Am I getting Rand hedge, for example? Am I getting high dividends? Am I getting an inflation-linked bond exposure? What is it that my client needs in the portfolio? And the purest and the best way to go and find that is in the passive exposure in the ETF or the ETN. You can then supplement that once you've actually sorted out the core, the basics of what the client needs in the portfolio. You can supplement that with the icing on the cake, the satellites. So you might call it sitting on the fence, active and passive. For me, this is rather like skiing with both legs. You really do need to have both of those. There are times when you can lean a little bit more to the one side than to the other, but essentially you do need both of those to actually give you a smooth ride over the mountains.
And I think obviously, Bronwyn, the question is what do you use as the core? Do you use the core being passive, or do you suggest using the core as active?
You see, we're now moving you away from the fence. Some way we're going to get you to choose sides.
Well, I'm definitely on the side in terms of passive for the core, because core essentially means what is the most important things that I need in my portfolio. So that could either be like a private client specific requirements in terms of income or whatever, as I've mentioned, or it can be for an institutional manager. What is the mandate that I'm mandated to track against or to perform against? And this is a great way to actually get the core very closely aligned to your mandate, and then use the active satellites to actually exercise those active views. Which are the shares or the sectors or regions or industries that you feel very strongly positive about, and add those to the core, in which you've basically covered the basics of what is required from your investment portfolio.
I think the question though is with a couple of products now, how do you get how should you get exposure to the market? Because there's the Swix index, there's the top 40 index.
It's a difficult decision-making process.
Yes.
And again, it's like selecting an active manager. How do you actually, if you can't judge them on past performance, which we keep being reminded of, but of course we do, how do you select your passive portfolio?
Yeah. Well, I think that's one of the beauties of passives, is that because there's an index which has got certain rules around it, it's a lot more okay to use history in terms of indices to give you an idea of not what the performance return-wise in the future will be, but how will it react to certain market conditions. So because your index stays pure to its investment mandate, if I can call it that, the high dividend plus index will always be exposed to high dividend paying shares. Whether they performing well from a return point of view or not is irrelevant. You know exactly what you're getting, and I think that's one of the big differences between passive and active. Is passive, there's no style drift. There's no moving away from the style which is defined in the index. What you see is what you get. Whereas with the active, I think we've seen in recent years, for example, that we've got a plethora of value managers. Value as a style has not performed very well, and now you start seeing some of them drifting away from that value style
and pressure for performance.
If performance is only based on return, yes. If that is all that you're interested in, yes, then the pressure is there. If the pressure in terms of performance is that I need exposure to a certain sector or a certain market or a certain region, then there's no pressure to move away from that mandate. An index gives you that. They're pure to their
Let's
mandates.
drill down now into the performance and what we have seen over the first quarter. Any overriding trends?
Well, I try to look at this in three different groupings because we've got so many different indices and ETFs and ETNs on offer. So these domestic assets that we can invest in, there are international assets that we can invest in, and then there are commodities and currencies. If we start with the domestic assets in particular, of course, even though they all trade on the JSE, they are not only equity based. We also do have bond indices and bond ETFs listed on the JSE. So there I would like to differentiate between what gives you equity market performance and what gives you, let's call it bond-like or cash type of returns. And in that group, I would include things like the preference share ETF or index, as well as the dividend plus one. Certainly the sector-specific ETFs and indices were the ones that performed the best. Property index you've already mentioned. The financial and industrial, the financial 15 and Indy 25 also did exceptionally well. On exactly the other end of the scale, the resources. Resources 10 was the worst performer.
Surprise.
Yeah. Exactly. But I think what it shows you is that in something like the top 40 or the Swix 40, you get a combination of resources, financials and industrials. Whereas a fund manager or investor who's got a particular view maybe had the view at the beginning of the year that resources will continue to underperform, does not have to expose himself to resources. He can actually focus just on the financials, industrials or property.
Nerina, I just wanted to get, and this is surprising considering, we talk a lot on the show, with fund managers talking about expansion opportunities in Africa and Latin America and Asia. Look at these returns from developed markets. Japan, 31.5% for the quarter. The US, which is the MSCI US, 20.2%. And the DBX UK, 18.7%. So just color that for us. What actually happened there? Because that sounds like indices in emerging markets as opposed to developed markets.
I think first and foremost we must acknowledge the role of the currency in it. The rand depreciated by over 9% during the quarter. Now the majority of these MSCI indices which are used as the basis for the ETFs and ETNs are dollar denominated. So you can take that MSCI Japan index in dollar terms or the MSCI US index in dollar terms, and then you've got to add another 9.2% on top of that, because when you invest in these international ETFs on the JSE, they trade in rands. So you buy in rands and your return is in rands. And that is why the MSCI Japan gave you over 30% for the quarter. We know that the Bank of Japan has been aggressively weakening their currency, which has been a great assistance to their exporters, and that's really what has boosted the Japanese equity market, and a South African investor can actually get exposure to that purely by buying the MSCI Japan ETF on the JSE.
Are the ETFs now overridingly positive for retail investors? Are you seeing that traction with retail investors across the board?
Absolutely. I think we're seeing much stronger acceptance amongst retail investors rather than under institutional investors. I do think that institutional investors still feel that this is what they paid to do. They paid to actually make these decisions. They don't want the index to make the decisions for them. But I think somewhere along the line you'll see more acceptance where they realize but actually choosing the right index is actually your first active decision. So to be invested in passive instruments like ETFs doesn't mean that you don't have an active view on certain markets or certain market segments.
I suppose one of the biggest advantages is the geographic diversification that you can get.
Absolutely. Geographic diversification, currency diversification, even exposure to industries and sectors that we don't have in South Africa. I mean, something like utilities, for example, we have got no electricity or water on our on the JSE, for example. Nothing in terms of the motor manufacturing sector. Very little in terms of food producers, and so the list goes on. Even a relatively small healthcare sector. So these are opportunities for investors to get exposure to other industries, geographies, currencies, and obviously growth profiles also, and actually supplement not just the growth potential of their investment portfolio, but also the diversification of the portfolio, which is so incredibly important.
Nerina, you just talk about giving investors access to these different markets and sectors and things, and obviously one of the ones is the MSCI Africa and China ETNs, as I understand it.
Yes.
ETNs are now being progressively used more and more to give exposure quickly, and they're products that can be created very quickly by banks, for instance. What pitfalls should investors be aware of when they consider an ETN as opposed to an ETF?
The most important difference between an ETF and an ETN is the additional credit risk that is added on when you talk about an ETN. It's an exchange traded note. So it is a debt obligation by the issuing bank to promise to pay the investor the performance of the reference index. So as long as you're comfortable with the credit risk of the bank, and in South Africa all the ETNs are issued by our large well-known banks, and certainly I think very credit worthy, so I don't believe that this is a particular additional risk, certainly not for the retail investor, but it is something to bear in mind. In terms of costs, you often find that managing an ETN is almost cheaper than an ETF, because in South Africa the majority of our ETFs are 100% physically backed, so it means you have to go and buy every single share in that index in order to give the performance or promise the performance to the investor. In the case of the ETN, they are allowed to actually use synthetic replication or futures or options or any form of derivative that they want to in order to fulfill their obligation towards the investor. So the two risks, credit risk is the one, and the other one is model risk or replication risk, and the extent to which that is used. So it's important that investors are aware of that. I don't consider it a particularly large risk, but those are additional risks.